one of the top questions a first-time buyer is asking up front is, how much home can I afford? And there's not just a great calculator online or a search you can do on Google where you can plug in numbers and get an answer. There's a lot of different methodologies, variables, and intricacies that will determine how much home you can afford, and it will be different from anybody else. So with that said, in today's lesson, I want to break down the different factors that go into it and tell you what you need to do to get the answer to that grailing question of how much home can I afford? Hi, it's Robert Weinberg, and on this channel we empower people to take control of their future through expert mortgage and financial strategies. In this lesson, we're going to talk about the answer to the question, how much home can I afford? Now, first and foremost, I want to talk about the methodology that financial advisors use. And it's really been said for many, many years and hasn't changed that most people should be spending no more than 28% of their gross monthly income, that's before tax and deductions, on housing expenses. And they say that you shouldn't be spending more than 36% of your gross monthly income on total debt. That would include your housing expense as well as student loans, credit card debt, car expenses, personal loans, etc. But I can tell you it's very rare in today's economy, in society today, that you will actually fit into those ratios. And I've seen many mortgages approved in my career that are nowhere close to those ratios. I've had clients approved with as much as a 45% housing ratio, meaning 45% of their gross monthly income going towards their mortgage payment, and as much as 56% total debt ratio, including all of their other debts. And on VA loans, I've seen even higher, as high as 60 and even 70+% on a VA loan. So it really can vary significantly, and that's why I was saying there's not a clean-cut answer. It's going to depend on a lot more than just plugging numbers into a calculator. So there's different factors that are going to play in. What's your credit score? Somebody that has a 740 score is going to have a different affordability than somebody that has a 620 credit score. What are your assets looking like? What are your reserves looking like? Underwriting systems are going to allow you more flexibility. They're going to allow you to push the envelope on how much you can afford if you've got money in the bank, whether that means retirement funds, savings, money market, cash value life insurance, those sort of things. The more money you have after closing, the higher your flexibility is going to be when it comes to the affordability. Also, loan program can make a big difference. Conventional loans are going to be the most strict when it comes to debt to income ratios and affordability. Whereas, as I mentioned earlier, VA loans are going to be super flexible and liberal when it comes to debt to income ratios, and they will allow you to take out even a 60 or 70+% total debt ratio with many VA loans, again, depending on credit score and other factors. So it's a lot more than just plugging numbers into a calculator. It also has to do with the specific property that you're interested in. So you may have one property that you're approved for $300,000 on, and then we run your numbers on a property down the road for $250,000, and that's going to be your affordability because maybe the taxes are more on that other property. The variables there that are going to come into play are going to be property tax differentials, insurance. Maybe one property has flood insurance, another one doesn't. That's going to affect your debt to income, and also property type. So condos are going to have HOA and common fees. A single family is typically not. And then a two-family property, you may be able to get credit for some of the rental income, which is going to allow you to afford a lot more than that same price point on a single-family home. So hopefully you're starting to understand that there's a lot of these different variables that go into it. So how do you know? How do we answer this question? You need to get with a mortgage advisor as soon as possible in the process. And the reason that that's so important is because a trusted mortgage advisor can run your numbers. They can run your credit report, run your income through an underwriting system that will analyze your credit. It'll analyze the underwriting guidelines and what you fit into, and it'll spit out very quickly whether you're approved or not approved, and we can run multiple scenarios through there. So maybe we run $300,000 and you're not approved. Then we run $275,000 and you are approved. So this is why you want to get with a mortgage advisor as early as possible in the process, as we always talk about, so they can run your credit, run this scenario through a system, a software that will actually underwrite automated to the guidelines of these different loan programs. That'll give you what you need as far as an approval amount. It's not just looking at a sheet of paper, looking at a pay stub, and saying, yes, you fit this, or no, you don't, because of all these other criteria that we've talked about here earlier. There's not a simple or easy method to say, if your debt-to-income ratio is higher than this or lower than this, you will or won't be able to afford a property. Okay, that was the way it was years ago, but now with technology and all these different loan programs, there's so many different flexibilities that we can do. Again, maybe you have reserves. Maybe you have a bunch of money in the bank. You're going to be able to get approved for more than the person that has a high credit score but doesn't have any money in the bank after closing, okay? So typically we recommend that you get with that mortgage advisor at a minimum 3 to 6 months before you're ready to move forward with a home purchase. I've had clients that get with me even a year or more beforehand. The sooner you can get with a mortgage advisor and have them run these numbers, the more flexibility you're going to have. Maybe there's some debt you can pay down to get your affordability to a higher level. Maybe there's some different things you can do to get your credit score up. If you only have 30 or 60 days to buy a home, then you're not going to be able to do those things because they take time. You want to be prepared and you want to be very methodical with your timeline of buying a property so you don't put yourself against the wall of needing a specific timeline and be in between a rock and a hard place of needing to meet that. So what you want to do once you are pre-approved is have your mortgage advisor run any deviation of that pre-approval amount on a property-specific basis through the underwriting system, okay? So maybe you got pre-approved for $300,000, but now you're looking at a house for $310,000. Don't assume because it's right around that amount that you're going to be okay. Again, every property is different. I have all my clients send me the address of the property that they're interested in putting an offer in so I can look up the property taxes and all these specifics on the property, and I run those numbers through the underwriting system before they put an offer in. This is going to make it so if there are problems, if there are issues, you're going to know way ahead of time. The last thing you want is to put an offer in on a house and then find out a few days later that, you're not approved for that property and you can't buy that house, okay? So that's going to ensure that there are no last minute issues and that there are no surprises. I really hope this helps, and I hope that you've gotten a lot of value from today's lesson on home affordability. I appreciate you watching this. Go ahead, like, share, comment. If it's your first time watching,